Hello everyone, my name is Daniela Ardrezzani. I am a Dottor Commercialista and I work in Asian Tax Advisory. The topic for today will be the residency, the criteria to be tax resident. My topic for today will be the criteria to be tax resident in Singapore for individual. And the agenda for today will touch three topics. The first of all are the main criteria for the individual. The second one is the possibility to work from Singapore without an employment pass. And the third part is working from overseas, having an employment pass in Singapore. So first topic, the criteria to be considered tax residents. So according to the Income Tax Act, the definition to be a resident in Singapore is the person who resides in Singapore except for such temporary absence which can be reasonable and not inconsistent to the claim to be resident in Singapore, and include persons who are physically present in Singapore or exercise an employment for at least 183 days. So, by the definition, we have two tests to be considered resident in Singapore. One test, the first test is qualitative, and the other test is quantitative. Just a warning, consider that the director of a company have a different regulation, a slightly different regulation. So for now on, I will talk about the general employee of the company, and then I will go back on the director. First criteria is the qualitative criteria. Again, and the person who resides in Singapore except for the temporary absence. There is no definition in the income tax regarding what does it mean reside and what does it mean temporary absence. So it's a factual matter. And there are some factors which are relevant to the definition of residencies. So for example, having family ties in Singapore, having a permanent accommodation, having a job, being abroad for a temporary period, and how long and the frequency for the visit in Singapore. So by right, the Singaporean are always considered tax resident. The temporary absence, again, there is no definition in the income tax about the temporary absence. And in general, we can say the person is a temporary absence when there is no intention to establish another residence in a foreign country. For example, a person who is post overseas for a short period of time, or a person who is away from Singapore for months or even years due to medical treatment. They are still considered tax resident, and the absence is considered temporary. The quantitative criteria. Under the quantitative criteria, a person is considered tax resident in Singapore when is physically present in Singapore or exercise an employment for at least 183 days. So physically present are usually the dependent pass, and exercise employment in Singapore are the employment pass holder. And for the calculation of the 183 days, we consider one half day as a full day. We consider the weekend the public holiday, and also or the absence which are incidental to the employment in Singapore, so the holidays or the business trip. This is the general definition, this is the general regulation. However, IRS has granted all the employment pass holder or the foreign worker or the foreign employment pass holder to concession. The first is the 2 years concession, and the other one is the 3 years concession. So according to the 2 years concession, those who work in Singapore for a straddling period of 2 calendar years and who stay and work in Singapore for at least 180 days, they are considered tax residents in Singapore for the both year. I give you two examples. The first one is a person who arrived in Singapore on the 8th of November and left Singapore on the 20th of November. In this case, both the conditions are satisfied because the person stays in Singapore for more than 180 days. And the second condition is the straddling period over 2 calendar years of the work of the worker. So, and this condition is satisfied here. The second example instead is a person who works in Singapore from the 8th of November until the 30th of December, and then stay in Singapore until the 20th of May. In this case, even though the second criteria is satisfied, so 180 days, there is no working straddling over 2 periods of time. So in this case, the criteria are not satisfied and the person cannot be considered tax resident in Singapore. Similarly, the 3-year concession. So those employment pass holders who work in Singapore for a period over 3 years, even though in each year there is no the 183 days working in Singapore, the person is still considered to be tax resident in Singapore according to this concession. So a couple of notes. Quantitative and qualitative criteria are alternative. So it's enough to satisfy just one criteria to be tax resident in Singapore. Split year. So according to Singapore, when the person is tax resident for part of the year, in Singapore is tax resident for all the year. So means if a person starts working in Singapore, let's say, for example, on the 1st of April, for the year can be considered, for the whole year can be considered tax resident in Singapore. So if the person earned in foreign income for the first part of the year, such income are not taxable in Singapore because foreign source of income are exempt in Singapore. Company director. Company director have a peculiarity, and it depends if they are executive director or non-executive director. So executive director are the director who work day by day over the company, and basically they have an employment pass or they have an employment contract. Non-executive director are those directors who just attend the board meeting. So the executive director, for the executive director, qualifies the quantitative test and the duration of the employment. For the non-executive director, instead, the qualitative test and the physical presence in Singapore. So once a person is considered tax resident, which are the consequences? The consequences are that the person can be taxed in Singapore based on the progressive rate, which are from 0% to 22%. Next year will be from 0% to 24%. May claim the personal relief, may claim deduction of the expenses. And the most important part is the exemption of the foreign source of income, even though they are remitted in Singapore. Second part, working remotely from Singapore. So this is the case when a person who is not employment pass holder comes and works in Singapore for a foreign employee. And foreign employee means also the representative office. So all those who have an employment pass under the representative office, they are considered working for a foreign employer. The general rule is if the person stays in Singapore for 60 days or less, all the income accrued in Singapore are exempt. If the person works in Singapore from 61 to 182 days, the taxation is as a non-resident, and more than 183 days, the taxation is as a resident, considered as a resident. So this is the case for example, for those who work for the representative office, but also those who are on business trip in Singapore. So they work for a foreign employer and they come in Singapore for a business trip to work with their subsidiary. This is a general rule, but by concession, IRS granted during the COVID time the possibility to be fiscal exempt in Singapore for all the income accrued in Singapore. And so until the 30th of June 2021, all the person working in Singapore, because they had travel restriction to come back to their employment country, they could be considered non-tax resident in Singapore, and all the employment income accrued in Singapore is considered exempt. So there is no taxation on such income. From the 1st of July, instead, from the 1st July 2021, the general rule apply. So all the persons who are working in Singapore and accrued income, employment income in Singapore, are considered tax resident, are considered taxable in Singapore, unless the person is able to demonstrate the impossibility to come back to the working employment country. So conversely, what happens when a person has an employment pass and works from overseas? So this applies the general rule. So the qualitative and the quantitative criteria. So I'll give you an example. Let's pretend the person is employment pass holder since the 1st January 2018. And keeps travel in and out from Singapore for both personal reason and business reason. This is a situation very common right now because we are trying to working remotely as much as possible, not only from home, but even from a different country. And so if you sum up the person, if you sum up the period where the person has been overseas, the total is 198 days, so means that by right, the person is not staying in Singapore for at least 183 days. So we apply the general rule, so the qualitative test and the quantitative test. According to the qualitative test, we may say that the person resides in Singapore because he has a working here, he has an apartment in Singapore, he has a daily bank account in Singapore, maybe has a family as well in Singapore. So the first criteria is satisfied, but we can also say that the quantitative criteria is satisfied because the person is absent just for a temporary occasional period which are incidental to the job in Singapore. So the person can be considered tax resident for 2022 in Singapore. But there may be problem or maybe issue with the resident country, with the home country, because maybe for strong family ties. And so we applied the double taxation agreement, and maybe the person could be taxed in that country. And according to the double taxation agreement, the income which are taxed overseas are taxed in Singapore, but the taxation paid overseas can be deducted in Singapore from the Singaporean taxation. This is another example which regards 2021. As you might remember, last year Singapore closed the border, so nobody was able to enter again in Singapore, even though having an employment pass. And a lot of person was blocked overseas, and they stay overseas for more than 183 days. And this is the example, this is the case. So for example, the person employment pass holder since 2018, forced to stay overseas for 245 days. So in this case, again, both the qualitative and the quantitative test applies and are satisfied because the absence is temporary and because the person can be considered resident, can be considered to reside in Singapore. The difference between this example and the previous example is connected to the double taxation agreement. So the person, again, can be considered tax resident in Singapore and pay taxation in Singapore. Anyway, can be considered also tax resident in the home country and tax in the home country. The difference is here, according to the general rule of the double taxation agreement, the resident countries withdraw the taxation paid in the home country. Instead, during COVID, since it was really an unprecedented period, IRAS is willing to not consider the employment income to be taxed in Singapore. So the person can apply for the mutual agreement procedure, can initiate the mutual agreement procedure with the tax authority in the home country and in Singapore, and the person can be not taxed in Singapore, so just in the home country. I think Marzo will talk more about the double taxation agreement and all the implication with the fiscal residency. So I leave the stage to him.
Thank you, Daniela. I am Marzio Morgante. I'm Daniela colleagues. I'm based in Hong Kong. I'm just passing by, and tomorrow we'll be back in Hong Kong during my quarantine. Has been usual for me in the past 2 years. So let's start. I will go through briefly the tax treaty residency according to the tax treaties, and we'll bring up a few examples. We will go briefly through the Italian tax residency criteria. Let's see if this goes. So why tax treaties are important when we define tax residency? They're important in the first because we can be tax resident for in 2 countries at the same time, and 2 or more countries at the same times, and that's not good for taxpayers, because then they will end up paying taxes in 2 countries or more wherever they are residents. So let's say at the international level, we needed to come out with a solution to define where a person is tax resident in which country, in case there is a double residency issue, and this one basically that's why the OECD level they came up with and the UN level also with tax treaty that countries sign to solve this kind of problems and others problem, but mainly we will focus today on the tax residency criteria. Because a brief introduction, a domestic test, so as we see just now with Daniela, countries may establish unilaterally their own criteria. So there are different criteria to establish a tax residency for individual, day counts, habitual abode, place of exercise of main professional activity, registration as resident with a municipality, which is, for example, this is the case of Italy, right? You just need to register, we will see afterward, but you just need to register, I think, as a resident in Italy, then this to trigger taxation unilaterally in Italy. Central vital of life, main interest, so and so on. At the OECD, so at the tax treaty level, instead, they tend to, there is simplified in order, there are 3 main criteria, let's say, there is a citizenship at the bottom. And so once this criteria is met, then between the 2 countries, that's the winning state, so-called, and that's where the person is defined as a tax resident in case there is a conflicting, when there are 2 countries claiming that that person is resident in both countries at the same time. So which is the permanent home, central vital interest, habitual abode, and citizenship. This is just an introduction, then we'll go through more details as this is called a tiebreaker rule, how it works in practice when there is this conflicting dual residency issue for an individual. We start with I think an example which we'll go through the definition of tax residency in Italy, which it may apply in most of the cases of individuals here. And So according to Article 2 of Italian tax code, how a tax resident is defined. I mean, if only one of these is verified, then the individual needs to be a tax resident in Italy. So the individual is registered in the registry of Inpatriation, or as a bit of both. In Italy, the individual is domiciled in Italy, which means that business, economic, and social interests, and for the family. So if an individual is a family in Italy, but then the individual is living outside of Italy, then is still deemed to be Italian tax resident as for a domestic Italian tax code definition. So the first, of course, the first condition is a mere formal individual qualified as Italian tax resident if, just because he is enrolled at the Italian resident population. And this, of course, may trigger challenges from Italian tax authority. In case the individual is a non-Italy tax on a ward by basis, and we will see later on. But still, if a person is non-resident, it doesn't mean that it's non-taxed in Italy. If he derives, is subject to a territorial-based taxation, meaning that the income which are sourced in Italy are still taxed in Italy. A typical example, if you are still resident here in Singapore, but you derive some rental income from Italy because you have like an apartment there, then that income is still subject to tax in Italy. Instead, always for tax residency purposes, is very important for Italian for the reason that we mentioned before, that they do enroll in the IRA registration, which is quite easy to do. IRA is the register for the Italian citizens which are resident abroad, and this can be done by embassy at a local embassy or consulate. For example, in Hong Kong, after you get a working visa. The date of efficacy of IRA registration. The IRA registration takes effect from the date of filing the request to the local embassy consulate. And this one is very important, as we see before, because basically, if you register at IRA before, let's say, before June for that year, then you will spend more than 183 days outside of Italy, and therefore you will need not to be tax resident for that year, and you will be taxed in Italy only for 183 days. Sorry, you will be taxed only in Italy only on a, let's say, on a territorial basis. Instead, if you do it after July, basically after the end of June, you'll be taxed in Italy so if you stay outside more than 183 days, you will be taxed on a worldwide basis. If you stay less, you'll be taxed in a territorial basis only. It is important also to know, especially for the Italian citizens which are resident in Singapore, but like in Hong Kong, that both Hong Kong and Singapore are still included in the Italian blacklist, meaning that they have a reverse proof that they are deemed to be Italian tax residents, the Italian citizen resident in Hong Kong and Singapore, unless proven otherwise by an individual. Which, I mean, of course, if you are ordinary resident in Singapore, it's easy. Let's say if you live here, but still there is a reverse proof. The burden of proof is on the taxpayer and not on the tax authority in this case. And then there is another concept which is important to keep track is for Italy, the timing of acquisition of tax residents. Italy follows the method of the so-called split year treatment. So no split year treatment of domestic law. And what it means this? So it means like in Italy, like if you have been, for example, if you move your residency in Italy in April, then for that year you will deem to be resident for the whole year. It means that you move to Italy in April, and for the income that you derived abroad from January to March, you will still be taxed in Italy, because remember that Italy taxes on a worldwide basis. Okay, so then this one may trigger, depending on the country you're coming from, this may trigger double taxation, because on that income from January to March, you'll be taxed in Italy, and you may be taxed also in Singapore, for example, or in Hong Kong, right? And then you may have some issue to claim the tax credit, because this one, according to it's a Italian position which is conflicting with the tax treaties, with a tiebreaker rule, because under the tax treaty, basically, you should not be considered as tax resident for the period from January to March, but Italy otherwise has a position like which is different from the OECD model, and therefore you may just incur in double taxation in this case. And unfortunately, there is not much you can do unless you go to court with the Italian tax authority all the way. But it's something that you need to keep in mind maybe before you do the planning to move back to Italy, because yes, this may occur in double taxation. Briefly, also, this is another example of tax residency definition. We saw the Italian definition, the Hong Kong instead definition. Hong Kong, for example, does not have has no domestic tax definition in its domestic law, and therefore there is a definition they need to define it under the treaty, which the Italy-Hong Kong treaty has organ reside in Hong Kong, meaning as a house or like habitual abode, it stays in Hong Kong for more than an entry 180 days during a year of assessment, or 300 days, which equals 70 years, are considered as tax residents. But again, this is like a special definition which applies to Hong Kong. It's quite peculiar because it's quite unique compared to the other state, which, like we saw before, Singapore and Italy, they have a built-in definition of tax residency within the tax code of the single jurisdiction. Something also important when you move abroad from one country to the other, you need to apply for a certificate of residence status. These are the criteria to apply in Hong Kong, but the same applies to Singapore. This may be useful, for example, like even like if you derive like passive income from Italy, or you're for example in Singapore, passive income meaning dividends or interest, then you want to apply the withholding rate, because if you have to like no treaty withholding tax, 20-30%. And then if you want to apply the lower withholding tax, then the Italian tax authority will request you like the certificate of residence status issued by the Singaporean, for example, tax authority, or by Hong Kong in this case. Otherwise, they will not apply the treaty. And it's something like, for example, this is the procedure you need to follow in Hong Kong in order to obtain the certificate of residence status. Singapore, what's the procedure? But it can be easy or can be a little bit more complicated. But for a case in Hong Kong, again, you need to prove that you've been in Hong Kong for more than 180 days, and there are some criteria in order like that the tax authority, they do verify, before to issue this the certificate. Like we saw before, like once we decide like, so countries like we saw now, Singapore, Italy, Hong Kong, they have their own definition of tax residency for individual. We may be conflicting, so we saw like you can be resident of 2 countries or more. So under the OECD model treaty, there is the tiebreaker rule, Article 4, which defines in case of conflicting dual residency what we need to go and look for. Countries need to go and look for in order to define where this individual is actually resident. So we start with the first criteria is permanent home, is the state where individual also. So if you own a house, for example, in Italy and in Singapore, if you own a house just in Singapore, it's easy, or even you rent a house and you don't have nothing in Italy, then it's easy and permanent home, and you define, okay, the individual is tax resident in Singapore, but maybe some individual they have 2 homes, one in Singapore, one in Italy. Then you see you go and check the center of vital interest. So where the person has economic relation, but the personal relation must receive special attention. Set of meaning where is the family, basically, right? So what we were saying before, that if the individual has a family in Italy and by the individual works in Singapore, then under the treaty, center of vital interest, the individual then is deemed to be resident in Italy and not in Singapore. Habitual abode, where a person stays more frequently. If like the center of vital interest can be both countries still, then we need to select another criteria, which is habitual abode, where the individual spends most of his time. If none of above works, then and it does happen when in special conditions, very complicated cases, then the tax authority of the 2 countries, they need to talk together and they put a procedure, which is quite lengthy, but so this is like what we saw before, the permanent home, how the tiebreaker rules applies, permanent home, resident. So the test that you have to go through in order to establish where the person is tax resident, you go through this process, this test through multiple steps. Why it's important also for the residency? Well, not only for tax, which is always related by the immediate, but also for, I'm sure maybe some of you, they've been going through the exchange of information, the CRS and so on. And this is like it's a quick check that basically like through the automatic exchange of information, you go through this test in order to understand if there is a person which is resident in Singapore, or can be in Italy or in Hong Kong, if it's reportable under the CRS, the automatic exchange of information or not, because of course the residency then it determines to which country the automatic exchange of information, which of course apply to Italy, Singapore, because it's provided by under the OECD, to which country those information are exchanged with. Okay, so if you may be an Italian tax resident, you hold a bank account here in Singapore, and then those information on your bank account will be reported to the Italian tax authority. The same does apply, like if you hold a bank account also in Italy and you're a tax resident in Singapore, then of course it's a matter of Singapore if you have to report your tax on it. But still the information are exchanged, and this year alone, like just came for the OECD. I was talking to the president of the OECD. They told me like something like $13 trillion worth of have been exchanged information through countries. More than 140 jurisdictions apply this exchange of information. So a lot of data have been exchanged during the past years, thanks to this agreement. What happens with for an Italian tax resident does not the reporting obligation with the Italian tax authority? The Italian tax authority has been especially recently quite aggressive on implementing the tax residency, especially during COVID and so on, and also before, like there've been a lot of challenging, and especially deriving also from the CRS, the Italian tax authority. They received a lot of data from abroad, and then they've been issuing like questionnaires and so on, challenges to Italian residency based on the information that they receive from abroad. Because as we discussed before, the individual is tax resident in Italy is required to pay tax on all the income wherever produced. So it's a worldwide income criteria and reporting obligation. You may not be taxed, but you still have to report it under Italian tax code. So like it's under Italian tax law required to basically you have to the financial investment held abroad. You have to in the section named RW of the Italian reporting obligation, and real estate investment, for example, held abroad and need to be reported. And this one, like why, like on the property tax is charged, it's called so-called IVAFE, 0.2% on those assets are taxed, which is not a lot, but still has to be taxed and need to be reported. Property tax on real estate on abroad, IVE, 0.76 of the value of the assets, real estate assets owned abroad. And of course, individual income tax still taxed in Italy. The fines, if you violate this obligation, are quite substantial. And then, and basically they're trigger and they're double in case like from 3 to 15% of the undeclared value. But in the case of Hong Kong and Singapore, so if you're an Italian tax resident and you held assets here in Singapore or in Hong Kong, since the blacklist country, those fines are double, so 6 to 30% of the undeclared value. It is important to note that that there is a presumption that those investments are formed by income not taxed, so meaning that whatever you held abroad is deemed to be not only is that deemed to be like the income which has been not taxed, and therefore the whole amount it will be taxed and fined in Italy. So which depending if you have failure to declare, which meaning that basically you did not report any tax, nothing basically, or unfaithful declaration, which was just under declare the income or the assets you held abroad. And in both cases, you see the tax fines are very, very, very substantial. So it's more than the assets you held abroad. So you have to be very careful when you move, for example, from Singapore back to Italy. That this is just to tell you that you have to be very careful when you move from Singapore back to Italy to declare all the assets. You may still keep the assets here in Singapore or in Hong Kong, wherever they are. It's not a problem, but they need to be correctly reported in the tax taxed and reported in order not to incur in these very high penalties. Yeah, so this one, I'll just go a little bit faster. There are not only like tax fines, but it's also like above certain thresholds. In case of for unfaithful declaration, it's also criminal. So there are some also criminal penalties. For example, if it exceeds like 100,000 euros or higher than 10% of the total amount of the active elements indicated in the tax return, or exceed 2 million euros. So, so in this case, it's punishment by imprisonment from 2 to 4 years and confiscation of assets. And this one, of course, that was unfaithful declaration. This is failure to declare. Failure to declare means basically like, yes, it's not being reported. So in this failure to declare, the threshold a little bit lower. We're talking about 50,000, not 100,000, and the imprisonment by ranging between 2 to 5 years, and confiscation always of the assets. For this reason, it's very important in case there has been a violation, basically to be not to wait a tax authority to come and get you, basically, but to do the first step and move forward. And there is active repentance regime. So basically, you can report that to the tax authority that, and depending on the on the timing. Then there are different, the fine, as you can see, though, is 1/10, so the fine are reduced substantially. But let's say like it is, and we go through the, but there is it's always better, at least also to avoid, in some cases, or to minimize the criminal charges, let's say, and the tax fines. We have seen, in case of a CRS, some questionnaire coming from the tax authority, which are not yet challenges, but just questionnaire coming because they receive all this data from abroad. So we had a few taxpayers coming forward with this, they receive this questionnaire. And in this case, it is important because before the start of a tax audit, to prove to the tax authority, because sometimes due to miscommunication, you might still argue with the Italian tax authority that you were not a tax resident in Italy, and therefore, like, it is important in this case to file, like, and we've done for some taxpayer, like a defensive, file a defensive deed to Italian taxpayer, that to demonstrate that you were a resident outside of Italy, to explain to the tax authority. This is very important to do it before, because then when instead if a tax audit, a proper tax audit starts, then it may trigger the tax fine that we saw before. So, because in case then you prove to the tax authority effectively, you have all supporting documentation to prove that you've been resident abroad, then in this case, the Italy loses any tax right and then the taxing right, and therefore so the reporting obligation. But for this reason, important to keep also for the future always track of all the documentation, because you never know. I mean, a tax inquiry may come anytime, and meaning that, I know, the rental agreement and so on, like transaction like credit card and, you know, phone and traveling bills and so on. Conclusion, the mail registration is important. So whenever you move to a new country, it's important to register at the local embassy. And as we've seen before, because this may avoid Italian taxation. And because of the anti-abuse rules, especially here in Singapore, the proof of residence taxpayer move back. It's on the taxpayer, let's say on the individual, and not on the Italian tax authority. That's why it's important to keep all track of all the documentation abroad. And this is like a list of recapping basically what we discussed above before, to minimize the risk to have challenging from the tax authority. And yeah, this is it then.
Thank you. I'm going to introduce from Deloitte that is connected from Hong Kong.
Oh. Okay. Ciao, Paola. Thank you so much. Can you hear me?
Just Francesco, because they can hear you, but they cannot see you.
Okay.
Okay. Yes, now they can hear and see you.
Okay, thank you so much. I try to share my screen. Can you see the presentation, Paola?
Yes, all good.
Okay. So thank you, Paola, and first of all, thanks to Marzio, Daniela, and Ata for inviting me to participate as a co-speaker for this interesting event. Thanks so much to the Italian Chamber of Commerce of Singapore. I'm very sorry that I couldn't be in person there, but of course, Hong Kong is still a restriction COVID country. So for now, I cannot travel free as I wish. Anyway, and at the end, thanks to all of the people that is attending this webinar. I really hope that it will be useful, and please, after this webinar, please feel free to send your question to Marzio and me, and we will provide an answer today or in coming days. So very briefly introduction of myself and what I do. I'm Francesco Vitali. I am a tax director in Deloitte. I work for Deloitte Asia Pacific, and we have a desk that is based in Hong Kong. We assist Italian individual and Italian company to set up their business in Asia. We assist them for tax planning and tax structuring, and vice versa. We assist Asian corporate and Asian individual to set up their business and their investment in Italy. We are in the Italian desk, including in Deloitte Asia Pacific, as I mentioned before, and with me we work with other colleagues from coming from different tax jurisdictions. So the purpose of our international desks is to provide tax consultancy, not only with reference to Italy, but in general, we try to cover all the world. Okay, now let's start. As mentioned, object of my speech today will be the introduction of a so-called Infiltrate regime, a regime degli impatriati. And this is one of the most important tax legislation that try to attract people from abroad to come to work in Italy. There are also other tax regimes in force, like the pensioners beneficial tax regime, the flat tax tax regime for high net worth individuals, and the other that are like the research and professor tax regime. But we think that the Infiltrate tax regime is for sure one of the most common and important for people that want to move their tax residence from abroad to Italy. And let me also say that the information that I will provide today are just general information and comment regarding the tax disposition and some common ministerial practice. But then I strongly recommend to everyone who want to benefit of this regime to ask an advice and confirmation to the tax advisory before to proceed, because anyway, it's really important to analyze case by case. So now, just as you can see in the slide, we did a very quick recap of how it works, the tax regime, and what are the main features. So what? It's a special provision that address to inbound employee under certain conditions. What is the purpose of the disposition? Is to attract workers to Italy. I say workers and I don't say Italian worker, because as we will see later, this disposition is applicable not only to Italian individual, but also to foreigner individual. How it works is reducing the taxable income, and what is the duration of this disposition? The duration of this disposition is ordinary is 5 years, but can be under certain condition extended to further 5 years, so total 10 years. And how to implement? The implementation of this disposition of this regime is quite easy, and later I will give you some tips about this, but it's quite easy, not very complicated. Okay, just for give you a very quick idea how was the evolution of this Infiltrate tax regime. So first of all, this disposition was introduced in 2016 with the so-called Decreto Internazionalizzazione. And then there is an evolution in the years, and the most recently update was in 2019 with the Decreto Crescita. And as you can see, the disposition at the beginning, the taxable income was reduced up to only 30%, then was reduced up to 50%. But now there is a more favorable disposition that reduce the taxable income to 70%. So it's meaning that for a taxable income of 100, the taxable income, if you can apply this regime, will be just 30. But in certain cases, the reduction arrives up to 90%, as we will see later. Okay, now, this is the requirement that needs to be met in order to benefit of this tax regime. So first of all, this regime is applicable both to workers and students. This is why there is no more when we talk about the so-called rientro dei cervelli, this is something different. The rientro dei cervelli, the so-called brain tax regime, it's something that is applicable to researcher and professor now. But now, for the people that move their tax residence from abroad to Italy, we have this Infiltrate tax regime. So it's applicable both to workers and students. Is a reduction of, as I say, is a reduction of the taxable income. Taxable income, and this income is the three types of income. It's employee income, assimilated to employee income, or for professional or freelance income. So also for autonomous work, they can benefit of this tax regime. The requirement, first of all, the subject, the move, the tax resident, they have not to be considered a tax resident in Italy in the 2 tax periods prior to the move. So what is important here is to consider when you move your tax residence, that is different, as we saw before, thanks to Marzio, to the definition of legal resident. It's something different. So maybe, for example, now we are in September. If you move your resident in Italy today, you are not considered tax residents for the 2022. So for the 2022, you cannot benefit of this beneficial tax regime, but you can start to benefit of this tax regime starting from the year 2023. And you should not be tax resident in Italy for the 2 tax periods prior to the move. So they talk about tax period, is meaning is not the usual year, is different tax period from the concept of solar year. Then second requirement is that the individual they commit to stay in Italy for at least 2 years after they move in their tax residence. So what does it mean? That if I move my tax resident in 2023, I need to stay I need to stay in Italy at least until the end of 2024, and then I can benefit of this beneficial tax regime for 2023 and 2024. And then, of course, if I move abroad again my tax resident, starting from 2025, I cannot benefit anymore of this preferential tax regime. So this is the second requirement. The third very important requirement, and this is the last main important requirement, is that the individual must work within the Italian territory. So for the major part of the year, the work seat must be the Italian territory. As we later see a case in which maybe we don't meet or we risk to not meet these requirements. So it's very important that these 3 requirements are met in order to benefit of this tax regime. As I mentioned before, this tax regime is not only applicable for Italian citizens, but is possible to apply also for European citizens, and in certain conditions also for non-European citizens. In this case, must be enforced a double tax agreement or an agreement with exchange of information between the 2 countries. So, just for give an example, since between Italy and Singapore is enforced a DTA, potentially the Singapore citizens can be included in this regime if also the other requirement, the other condition will be met. And it's possible for the student, as I say, for benefit of this tax regime, if also they are considered to study abroad for the 24 months prior to the movement. I want also to say another things that, as I mentioned, the ordinary reduction provided by this regime is 70%, the reduction of the taxable income. But if they move, they transfer their residency in one of the so-called southern region of Italy that I highlight in the map of Italy in green, that are these Abruzzo, Molise, Puglia, Campania, Basilicata, Calabria, Sicilia, and Sardinia. If they move their tax residence in one of these regions, the reduction arrives up to 90%. So it's really, really, really important. Just to give you an idea, in the range, the average of the effective tax rate in case of 70% reduction is around 10% of effective tax rate. And in case you move your tax resident in one of the southern region, the effective tax rate is around 4%. So it's really, really convenient, and really it's like Italy became a sort of tax haven for the people that can benefit of this Infiltrate regime. As I mentioned, also it's quite easy to benefit to apply for this beneficial beneficial tax regime, since in this case for an employee is just necessary to send a self-declaration to the employer, just confirming that they can meet all the requirements in order to benefit of the tax regime, and the employer, if agree, because it's not automatic, they will apply the withholding tax, the usual income withholding tax, on a gross salary of the employee on a reduced income taxable basis. If the employer not agree, in any case, the employee can still benefit of this preferential tax regime, but in this case, he has to do by itself in its annual tax return, that can be the 730 form or the modello redditi persone fisica form. In case the individual is not an employee but is a professional or a freelance, he can apply of this tax regime when he submits his tax declaration, or he can ask to his client to apply the withholding tax on a lower amount of the fee at the moment of the payment. So it's quite easy, but of course, in case you are an employee, if the employer is not sure that you can meet this requirement, can deny to apply the beneficial regime as you ask him. Very quickly here, because anyway, this is a part already well described by Marzio before. Originally, in the first disposition of this law, in order to apply for this benefit, you should be enrolled to IRE. But now it's possible, even if you don't apply for IRE, it's possible to benefit of this legislation if this individual qualifies tax residents abroad according to the Convention against the double taxation. So it's important that if you are not enrolled to the IRE, at least you are tax resident in a country that has a DTA, a double tax agreement in force with Italy. In this case, you, as described by Marzio, you should understand if you are tax resident, if you can be considered a tax resident in Italy according to the Article 4 of the double tax agreement. Of course, as I mentioned before, if you are tax resident in Singapore, it's possible, and you didn't enroll for IRE, in any case, you can still benefit since between Italy and Singapore is in force this double tax agreement. Okay, now, as I mentioned before, it's possible the ordinary duration of this tax regime is 5 years, but it's possible to extend for further 5 years, so total of 10 years or benefit, if in 3 alternative situations. So in any case, you cannot exceed the 10 years, but you can extend the benefit for other 5 years if one of the 3 situations that now I'm going to describe will be met. First of all, for if you have at least one minor or dependent child, in this case, for the further 5 years, you can still benefit of a reduced taxable income, but in this case, the taxable income will be not reduced anymore up to 70%, but up to 50%, as in the case in which you became owner of a residential real estate unit. You should be owner or co-owner, but you cannot have in lease this real estate, and is important that you sign a final purchase agreement and not just a pre-intentional agreement in order to consider owner of this real estate. In a third cases, if you have at least 3 minor or dependent children, the extension can be of course done, and in this case the percentage will be not anymore 70%, but arrives up to 90%, so even more convenient in this case. Then I report here a very controversial case, that is the case of the secondment. So many people is sending to work abroad with a secondment agreement. Now, when you have a secondment agreement, when you have a secondment situation, it's really important that you evaluate your case with your tax advisor, because the secondment is one of the cases more difficult to understand and usually more challenged by the Italian tax authorities. Very briefly, what is important is that you have a discontinuity between the position held in Italy before and after the assignment. This is very important. You cannot go in secondment in the other country and then come back in Italy with the same position, same level, same mansion. In this case, you have high chance that you cannot benefit of the tax regime. So, but if you, of course, if you work for different employer, you have different position, and you do basically a different job. In this case, there is a high chance that your tax relief will be applicable. I say this because many people think that since they just work maybe for 5 years abroad and they can come back in Italy, they can benefit of this tax regime, but it's not like this. Usually, when you have a secondment, this is a classical situation in which the Italian tax authorities challenge the application of the tax regime. And at the beginning, until 2018, the secondment was out of scope of this tax regime. Then, after 2018, with some common practice, ministerial practice, the Italian tax authorities open a door for certain cases. But anyway, I strongly recommend to evaluate your situation if you have a secondment. So I also prepare some cases that are some particular cases that, just for give you an idea, this is not this is just general. I don't want to give any solution, or I don't want to give any specific or accurate information of these cases, but I want to give just some idea. So there is the case in which you have a non-resident employer. It's possible, if you have a not resident employer, to still benefit of the tax regime if you move your tax resident in Italy and you work in Italy. So, for example, you have your employer is a Singaporean company, and you can work from Italy for this company. It's possible. You have to pay attention to other tax consequences. For example, an issue related to the permanent establishment of the foreigner company in Italy. So this is why you have to evaluate also this case. Then there is the case of the return in Italy after a secondment abroad. As I mentioned before, this is a very, very important and very common situation in which tax authorities can challenge the application of this tax benefit. So again, you have to evaluate your situation before and after the secondment, before to be sure that you can apply this tax regime. Then there is the case of the smart working abroad for an Italian employer. So what does it mean? You work for an Italian employer, but then you decide to stay and to work from Singapore for this Italian company. Okay, you can still apply for this tax benefit, but it's very important that for the majority part of the year, you work in Italy, physically in the Italian territory, because as I mentioned before, you should work for the majority part of the year in Italy. So pay attention if you do smart working that you can demonstrate that for the majority part of the year, you work from Italy. Then there is the opposite case, smart working in Italy for a foreigner employers. This is similar to the first case, so you can work for a foreigner employers in smart working in Italy, but again, be sure that you move your tax resident in Italy before to benefit of this tax regime. And again, also in this case, there is the issue of permanent establishment of the foreigner employer in Italy. Then transfer in Italy without work. So what does it mean? Today, you decide to move your tax resident in Italy, but you don't have yet a work. So in this case, you cannot benefit of the tax regime, because in order to benefit of the tax regime, you should have already a contract, or anyway a pre-agreement contract with an Italian company that want to hire you, or in any case, you should have already a work, an employment contract that show that you are gonna work in Italy, because the purpose of the law is to attract people that come to work in Italy. So if you don't have yet your work contract, you cannot benefit of this regime. Even if maybe you find a job after 6 months, you cannot, in any case, to benefit of this regime. So this is something that is very important to have before the move. Of course, if during the period, during these 5 or 10 years, you change employer, doesn't matter. You can still benefit. But at the moment in which you move your tax resident, is really important that you already have a contract, a work contract. Return to Italy with your, for example, you have a foreign spouse. She can, or he can, your partner can also benefit of the preferential tax regime, but also in this case, it's important that at the moment in which your partner move also his or her tax resident, also in this case, they need to have already an employee contract in order to show that when they move their tax resident, they can start to work in Italy. If not, is denied application of the preferential tax benefit. At the end, I just put some numbers just for give you an idea. This is really a rough computation, it's just an idea, but for give you an idea how it works and what can be the save for the company or for the employee in case they apply for this preferential tax benefit. So let's start with, for example, case one. We have an ordinary tax regime, an ordinary situation. For in a case of gross salary of 100,000, the net employee salary is around 56%. So it's meaning that, and for the company, the total cost will be for the gross salary of 100,000 euro will be almost 140,000 euro. So it's quite expensive. In case two, we have the application of the tax regime, and in this case, we have an extreme situation in which benefit only the employee. So in this case, if we have the same gross salary, 100,000 euro, we have, as you can see, we have same cost for the company, but the net employee salary will be increased up to 83,000. So it's a big save for him, and he will have a bigger and higher net employee salary. Then we have another extreme situation that honestly I think almost never happened, in which we have the same net employee, we start from the same net employee salary of the first case, so 56,000 euro. But in this case, the cost for the company, since they have a lower tax burden, in this case, the cost for the company for the salary of this subject will be decreased from 140,000 euro to around 90,000 euros. So it's a huge save also for the company. Usually, for my experience, we are more in case two than case three, of course, but this is something that can be agreed with your employer, or in case they want to find a common point, find a common solution. So it's possible to find a situation that fall between case 2 and 3. Okay, so my presentation is ended. I hope that was useful for you, and I leave again to Paola and the Chamber of Commerce the stage. If you have any other question or information, I'm here.